UBS cut Goldman Sachs' price target from $230 to $160 today. The analyst Brennan Hawken joins us now by phone. Brennan, why today and why that much of a drop?
Hi, Lonnie. Thanks for having me on. Well, why today? Realistically, we've been having discussions with investors for the past 6 weeks, ever since this volatility began, about what the implications could be, what the scenario analysis is. And we're coming here to the end of the quarter. It's normally right about the time we would true up estimates. It's a bit early for us at this stage, but we thought that actually putting formal estimates out there might further the debate and continue to keep eyes focused on fundamentals in what has been a truly challenging market environment. And so that's the answer on the why now. As far as why this magnitude, it's about the disruption that we're facing, what the impact that's having to investment banking operations, market-sensitive businesses like the asset management business, lower likely marks, some potential headwinds, both from credit spreads and from equity valuations. And so it's a combination of factors, along with general, lower velocity to economic growth, which of course Goldman Sachs has a lot of sensitivity to.
What does the last 2 weeks of trading mean for the much-hyped Solomon sort of revamp of the bank, Brennan?
The last few weeks, Solomon's revamp and the new strategic direction of the new management team is really a 3 to 5 year venture, not something that is going to be impacted significantly in a period of weeks. What I would say is that the implications of a slowing economy, a lot of it's going to depend upon how much this slows the economy globally. If this disruption puts us into a bad scenario where we have an L-shaped recovery on the back of it after this disruption, then that could end up being a setback, right? It could cause them to decide that they don't want to press forward with certain levels of investment. It's certainly possible. But to be blunt, I doubt it. I think that this is the sort of thing that the management team has decided a long time ago. They've decided that this is in the best interest of the company in the long run, and therefore, they're going to be pressing ahead. And so my sense is it probably doesn't have much impact on the new strategic direction at all.
I want to switch gears slightly. Brennan, you also cover some of the private equity companies, Apollo, for example, which came out last night and sort of reassured markets, in fact, tried to light a fire under certain companies, really, by suggesting that there was so much opportunity out there now. This contradicting comments that we had heard from activist investor Bill Ackman, for example, that many portfolio companies in these private equity companies were going to be in deep trouble. What's your outlook on Apollo and the other private equity companies that you cover?
Yeah, so we have my colleague Adam Beatty, who works very closely with me. He covers the alts, and I'm on the reports with him, of course. He's neutral on Apollo and Carlyle. He likes Ares here, and that's actually worked out really, really quite well. Apollo yesterday, to your point, came out and walked through some of the marks that they're likely to take on the portfolio. Those marks were meaningfully less than feared. Also spoke to deployments picking up. Apollo is a little bit more uniquely positioned given their strength in credit, especially distressed credit. This is the type of environment that Apollo has been probably waiting for. And so interesting to hear that they've been able to already put money to work. It suggests that, the volatility has led some credits that might have been already in some trouble to start to look for exits and allowing Apollo to make attractive entry points. I'd say it feels a little bit early. Typically, when we see a drop in the market, there's a wider bid-ask spread, and it takes a while for the bid-ask spreads to narrow in between where the buyers want to buy and the sellers are willing to sell. It might be a little bit different in some of these distressed credit markets where really financing conditions have tightened significantly. Credit markets, issuance is down dramatically. It's pretty much shut. And so they don't have many options. So I think Apollo might be a bit more uniquely positioned to benefit to a greater degree from that dynamic.